In 1998, some of the smartest people in finance came closer to collapsing the global financial system than almost anyone realized. Their fund was staffed by legendary traders. It employed Nobel Prize winning economists. Its strategies were built on sophisticated mathematical models designed to measure and control risk. Wall Street trusted them. Banks lent them billions. Investors believed they had discovered a safer way to make money. Then within a matter of weeks, everything began to fall apart. The model stopped working. Losses exploded, and a hedge fund run by some of the brightest minds in finance suddenly threatened the stability of the entire global market. This is the story of long-term capital management. Long-term capital management, often called LTCM, was founded in 1994 by former bond trader John Meriwether. The team was extraordinary. It included some of the most respected figures in finance and academia. Among them were economists Myron Scholes and Robert Merton, whose work helped transform modern financial theory. The fund specialized in identifying small pricing discrepancies between financial assets. Its strategy was based on a simple idea. Markets occasionally misprice securities. Over time, those prices tend to converge. LTCM would identify those opportunities and place trades designed to profit when normal relationships returned. The gains on each trade were often small, but with enough leverage, small gains could become enormous profits. For several years, the strategy appeared brilliant. LTCM promised something investors rarely hear: high returns with relatively low risk. The firm's mathematical models suggested that many market movements were predictable within certain ranges. Historical data showed that pricing relationships between assets tended to return to normal over time. If a bond became slightly cheaper than expected, LTCM would buy it. If another became slightly expensive, LTCM would sell it. Eventually, the spread would close. Profit would follow. The strategy seemed scientific. It wasn't based on intuition. It wasn't based on speculation. It was based on probability. The fund quickly built a reputation for sophistication and discipline. Investors were eager to participate. Banks were eager to lend. The combination appeared unstoppable. If markets behaved roughly as they had in the past, the models suggested that significant losses were extremely unlikely. That assumption would become the fund's greatest vulnerability. LTCM's early performance was exceptional. The fund generated strong returns year after year. Its reputation grew rapidly. Investors viewed the firm as a collection of financial geniuses. Success attracted capital. Capital attracted leverage. And leverage amplified returns. Soon, LTCM was borrowing enormous amounts of money from major financial institutions. The scale became extraordinary. Although the fund managed only a few $1 billion in actual capital, its positions eventually reached well over $100 billion. Its derivative exposures were far larger. Banks felt comfortable extending credit because the fund had an exceptional track record. Its leadership inspired confidence. Its models appeared rigorous. Its risk management systems were considered among the best in the industry. The rise of LTCM reflected a broader belief emerging throughout finance that mathematics could reduce uncertainty, that risk could be measured precisely, and perhaps even controlled. For a while, that belief appeared justified. Then the world changed. The crisis began far away from Wall Street. In 1998, Russia defaulted on portions of its government debt. The event shocked global markets. Investors became increasingly risk-averse. Capital rushed towards safety. And suddenly, many of the relationships LTCM depended upon began moving in the wrong direction. The problem wasn't simply that markets behaved unexpectedly. The problem was that they behaved in ways the models considered extremely unlikely. Assets that were supposed to converge continued diverging. Spreads widened instead of narrowing. Losses accelerated. Leverage transformed what would have been manageable losses into catastrophic ones. The fund's positions were so large that exiting them became difficult. Selling pushed prices further against them. Banks began demanding additional collateral. Margin calls arrived. The situation deteriorated rapidly. LTCM's models had been built using historical data, but history had not included the exact conditions now unfolding. The fund discovered a painful reality. Risk that appears impossible can still occur. And when leverage is extreme, even small deviations from expectations become dangerous. The smartest people in the room had built a system that worked perfectly until it didn't. By September 1998, LTCM was on the verge of failure. Its losses had become so severe that regulators feared broader consequences for the financial system. The concern wasn't simply the fund itself. The concern was what would happen if its enormous positions were liquidated suddenly. Major banks around the world were exposed. Financial markets were already unstable. A disorderly collapse risked creating a chain reaction. The situation became so serious that the Federal Reserve Bank of New York helped coordinate a private sector rescue. A group of major banks injected capital into the fund and took control of its positions. LTCM survived temporarily. Its investors did not. The fund's reputation was destroyed, and one of the most celebrated investment firms in history effectively came to an end. The collapse of LTCM became a defining moment for modern finance. It forced institutions to reconsider leverage, risk management, and the limitations of financial models. The event also demonstrated how interconnected markets had become. A hedge fund with only a few $billions of capital had nearly destabilized the global system. Not because of fraud, not because of criminal behavior, but because of scale, leverage, and misplaced confidence. The lessons would influence risk management practices for years, though many would eventually be forgotten. LTCM failed because its assumptions failed. The firm's models were not useless. In many ways, they were brilliant, but they were built on a dangerous belief that the future would resemble the past. Markets are not machines. They are systems shaped by uncertainty, fear, and human behavior. The collapse of long-term capital management remains one of the clearest reminders that intelligence alone cannot eliminate risk. Sometimes the most dangerous words in finance are, "This has never happened before."